Hi everyone, thanks for tuning in. Today I'm joined with Adrian, our in-house portfolio manager, and we're going to be talking about earnings season. But before we get started, please note that everything we discuss here today is just our opinion and it's not investment advice. If you do decide to invest, please know that your capital is at risk. So, Adrian, it's obviously been a busy couple of weeks for you and the investment team. Tell us a bit about earnings season, what exactly it is, and what it means for us.
Yeah, it's a very important period for us in the investment team at Sidekick, because earnings season gives us an opportunity to hear directly from the companies that we invest in or the companies that we follow. On a day-to-day basis, it means we are busy updating our financial models with the new data points that we receive. We make sure that our investment theses are on track. And more broadly, it gives us an opportunity to kind of build a picture of what's happening in the world from the bottom up.
What does that actually mean for our customers and their portfolios and how you're kind of managing that?
You mentioned we're going through a very busy period. It doesn't mean that we are trading a lot, for example. So we don't buy things going into the earnings season and sell them afterwards. We are not into this volatility game. We try to figure out how the world is going to look 18 months plus from now. And that's how we shape our views and that's how we pick stocks. Doesn't mean that we're not paying attention to what's happening in the present. So that's why it's very important that we track all of these companies and all the companies that we follow. So, we are like long-term focused, but laser sharp on the present.
I noticed in one of your recent articles, you said that you were kind of cautiously optimistic about earnings season. Tell us a bit more about that and how it's all kind of turning out at the moment.
Investors like to use this phrase, cautiously optimistic, because it's kind of hedging a little bit your views. But in our case, there's a real basis for why I said that. And the optimistic part comes from the fact that the bar has been lowered considerably going into the earnings season. So if we look since the beginning of the summer, earnings expectations from the analysts have come down by something like 6 to 8%. So we thought with such low expectations, companies are going to come out and most of the time beat or meet expectations. And this is what we're seeing so far. Companies are beating on the sales line by 2-3% and on the bottom line by 6 to 9% in the US, for example. It's the same story a bit lower in Europe, where sales are coming in line with expectations, but earnings are 2-3% above. So good numbers from the companies if you compare them with analyst estimates. But the cautiousness part came from the fact that markets have been really strong year to date and valuations have re-rated quite a bit. So a lot of this good news was already in the price. And again, so far, this is what we're seeing. We're seeing really good numbers, beating expectations, but then the share price reaction is muted or even negative in most of the cases on average.
It's interesting that you say that because obviously we've seen mega cap companies actually having quite a positive reaction, the likes of Alphabet, Google, Amazon. Can you tell us a bit about that?
It's a good point, and it's a very important point because a lot of the market narrative has been driven by these mega caps, and investors are focused on them for good reasons, and we are as well. And they are driving a lot of the big indexes, so it's only natural that we focus on them. But then if you look under the surface, you look at the companies outside of the big tech, the big Magnificent Sevens and so on, you will see that there is actually quite a bit of anxiety in the market. We've seen this in April when MSCI World was down 3 to 4%. So yes, the AI theme continues to thrive, albeit we think that investors now have shifted from buy anything that is related to AI to more of a show me story, where the companies are coming out with numbers and people want to know how is AI impacting pricing, how is AI impacting productivity, how is AI impacting customer conversion. We need to be a little bit more picky when it comes to investing into the AI theme because not everybody is going to be affected in the same way. And we've seen this with Meta, which was the outlier this reporting season. You mentioned all these companies, Google, Microsoft, Amazon, they all had pretty good numbers and pretty good share price reactions. Meta, on the other hand, saw a pretty negative share price reaction on decent numbers, I would say. And the reason for that is that Meta has been an exceptional investment over the last year and a half. And they've been playing defense for most of this time because expectations were so low. And its CEO came out with a plan with a year of productivity where they delivered every quarter on what they promised. And investors have rewarded them handsomely. The share price are one of the best performers in MSCI world. It's been up 200%. But the game is now shifting where you go from defense to playing offense. You need to show the next leg of the story where you're going to get investors excited. That it's a totally different game. And that's why the share price reaction was as it was, because they need to make investments for the next leg of the equity story. It's turning into a show me story. On the other hand, Alphabet, we think, is 6 to 12 months behind Meta in the journey. They are still playing defense. They are still fighting bearish investors who some still think that AI is going to be more of a threat for them than an opportunity. Obviously, we think it's going to be positive for them, which is why we have a good position in flagship. But they came out with an almost perfect quarter. The share price reaction was up 10-12% on the day. So we are happy with how the story is progressing there, although we think there's more to go in some way.
Fantastic. It's really interesting. So obviously in the news, it's been very kind of tech, AI focused, but there's a whole bunch of other industries outside of this. Tell us a bit about those industries, sectors that you're kind of looking at the moment, and what's kind of piquing your interest at earnings season.
There are a couple of areas where we notice some things happening, and one of them is the consumer discretionary area. We've heard from Amazon the other day, for example, you wouldn't see it in the share price reaction because Amazon is driven by AWS and cloud and technology and so on. But on the retail side, the sales are slowing, and the comments from the CEO were quite cautious with the consumer downtrading a lot. And then those comments were echoed by Starbucks CEO and share price reaction, which was down teens on a negative surprise. And, even McDonald's had some relatively cautious comments about the state of the consumer in the US. And then we had company like Hugo Boss in Europe that reported numbers, and investors are concerned about the state of the consumer. So the share price was down something like 6-7%. We are seeing these pieces of weakness in the consumer space. Again, it's too early to build a full picture, but you want to take the pulse of the state of the consumer. You look at retail, you look at restaurants. That's where it usually starts. That's where people start to cut when they feel the pinch. And to some extent, this is normal because the savings that consumers have built over the COVID period are running pretty low at the moment.
I was going to ask, what do you think is driving that kind of downturn at the moment?
Basically, the savings that were built during the COVID are running really low, and then it's interest rates. We started the year, the consensus that we're going to get something like 8 interest rate cuts from the central bank. We are 3-4 months later, that view has completely shifted, and we're going to be lucky if we're going to get 1 interest rate cut this year. This is affecting consumers, especially in the US, which is such a credit-driven market. So consumers are feeling the pinch, and it's only natural that and start cutting first from those discretionary categories. Now I know you're probably wondering, McDonald's is not necessarily the highest end category that you would cut, but people, they don't trade. They go to frozen pizzas or cooking at home, or you can see it in the numbers. Again, 1 quarter only, but it's something that we are keeping a close eye on. You asked me about what else we have seen. I gave you a kind of like a negative one. Let me give you a positive one, which is industrials, where companies are coming out with pretty good numbers and pretty positive outlooks. And that is because we are on the cusp of a capex boom. There's a lot of investments that go into this kind of like infrastructure industries, which you don't see it on the consumer side, where we are more exposed because we live it day to day, and it's a lot easier for us to understand. But yeah, this is a positive area of the market.
Well, thank you for sharing, Adrian, and thank you everyone for staying tuned and watching this video on earnings seasons. If you want to learn a bit more about what's happening in our portfolio, the performance of our flagship portfolio in particular, make sure to download the app on the Google Play Store and the Apple App Store.